Welcome to InvestaMania, brother.
Boom! What's up, InvestaManiacs? Jordan Knight here with InvestaMania, the show where we help you get rich. And we have a little fun along the way. Discovery Communications is launching a streaming service. It's about time. This service will include content from the Food Network, TLC, the Discovery Channel, HGTV, Planet Earth, A&E, the History Channel, and Lifetime. All those shows you watch when there's nothing else to watch on. Discovery Plus will launch at $5 per month for the ad-supported version and $7 per month for the ad-free version. Discovery is partnering with Verizon to give 55 million Verizon customers up to 12 months of Discovery Plus for free. The service is slated to launch January 4th, 2021, about 5 years too late. Discovery has not stated where the streaming service will be available. As you may recall, Peacock was initially unable to strike a deal with Roku and was absent from Roku, the most important platform in all of the United States and the whole world. Roku is the #1 streaming platform in America, and it's relevant whether or not Discovery Plus will be on Roku or not, so I do not like that Discovery didn't disclose their distribution channels. I mean, hopefully they're on Roku. I'm just saying I'd like a little bit of confirmation after what happened with Peacock. So should you invest in Discovery? I'd say this is a wait and see situation. Although in the recent past, I have not been so much a fan of Netflix due to increasing competition, and I thought that was going to bring the valuation down for Netflix. Historically, for many years, I was a big supporter of Netflix. I love Netflix stock. I was also a big supporter of Disney leading up to the Disney Plus release. But now the market is just too crowded for me to blindly hand money over to Discovery. Look at the competition. We've got Netflix, we've got Hulu, Disney Plus, HBO Max, Apple Plus, CBS All Access. Also launching in early 2021 is Paramount Plus. Lots of pluses we got here. That's from Viacom CBS. Oh, and by the way, there is free competition too. Free ad-supported competition, that is. Amazon Prime, which, okay, technically it costs money, but let's be honest, it's effectively free since everyone has Prime and they're going to keep Prime for the shipping. So you kind of just essentially get Amazon Prime Video for free, right? Then you got Peacock, which offers a free ad-supported tier. In my opinion, Peacock is currently the best genuinely free ad-supported streaming service out there right now. Check it out if you haven't. They have a lot of content, and for free, it's really impressive. And let's not forget Netflix's #1 watch show, The Office. Well, they're going to be leaving Netflix this month and going to Peacock in January. Then there's the Roku channel, Pluto, Crackle, IMDb Free Dive. Hey, those are all free ad-supported streaming services. So let's be honest. How many people are really going to pay $5 a month for an ad-supported version of Shark Week? I'm teasing a little bit. We all know someone who loves watching, the cooking shows or those home renovation shows. But here's the problem with those types of shows. It's usually not the person that you're watching the show for. It's just the content, right? You just want to watch stuff about cooking or about flipping homes. Who's running the show, who's on screen is less important. People typically just fall in love with whoever the host happens to be. They are easily replicable television shows to make. There is little barrier to entry for this type of content. So if it is doing well, other streaming channels can replicate this type of content pretty easily. I will say I do like the Verizon deal, however. Disney Plus had massive exposure right out of the gate, and this was in part due to their Verizon deal. Similarly, HBO Max received a boost from its deal with AT&T, which is also its parent company. Apple Plus receives a boost every single time you buy an Apple device. Hey, you also get a year of Amazon Plus for free. I think Discovery Plus will get much more exposure than it otherwise would without a Verizon deal. But in the end, Discovery Plus is just so late to the game. There's so much competition. I need to see some actual numbers of paying customers, not just the free Verizon customers, but paying customers before I feel comfortable placing my hard-earned dollars into this stock.
And now it's time for your Robinhood stock market update.
Yesterday, the UK, that's the United Kingdom, became the first country to approve Pfizer and BioNTech's COVID-19 vaccine. The first doses will roll out next week. The UK's approval may place higher pressure on the FDA to approve a vaccine in America. A quicker vaccine approval process would be positive for the reopening stocks. You know, those are kind of like the cruise ships and the travel stocks and the retail stocks, things of this nature. At least in the short term, this would be good for those types of stocks. Citi's venture capital side hustle is surprisingly active. Venture capitalists, those are the guys that invest in private startups with high growth potential. In exchange for their money, they get shares of the company, which they hope will eventually translate into a lot more money when they maybe go public. Make a little more money? A little more money when you go public? Citi is trying to join the ranks of Andreessen Horowitz, Sequoia, and Monica. The release numbers look pretty good. Citi Ventures has invested in 9 unicorns. Nine unicorns. A unicorn is a privately held startup with $1 billion plus valuation. 6 of those companies have gone public. Since 2015, Citi has backed 61 new portfolio companies. Previously, Citi had also invested in companies like Plaid, which Visa acquired for $5.3 billion, and Jet.com, which Walmart bought for $3.3 billion. When those companies get bought or go public, Citi cashes in, sometimes with massive returns. Other notable Citi investments are Square. I mean, come on, we all know how that one ended up. The mobile payments company IPO'd at $9 a share back in 2015. Now those shares are worth over $200. Dang. Hey, what about DocuSign? They got in on some DocuSign. The e-signature classic has more than 5x'd in value since its 2018 IPO. And then there's Honey, that's a digital coupon company, which PayPal bought for $4 billion. Citi appears to have a pretty good track record, and this may be why two-thirds of Citi's portfolio companies have a commercial relationship with Citibank itself. What do I mean by this? Citi uses, say, DocuSign to offer customers free e-signatures. By knowing and using the products that it is investing in, Citi has a better grasp on their value and growth potential. Hey, if they are using a company like DocuSign, then there's probably a good chance that many other large companies will also end up using them. Nasdaq makes big moves for boardroom diversity. Nasdaq is a publicly traded company which owns and operates the tech-heavy Nasdaq stock exchange. Now, it's looking for SEC approval to implement a board diversity mandate for the roughly 3,000 companies listed on its exchange. It would be one of the biggest moves ever made to mandate diversity for public corporation boardrooms. Nasdaq's proposal is to require companies to have at least one woman on their board and a director who is a racial minority or who identifies as LGBTQ, because apparently those are the same things according to Nasdaq. 75% of Nasdaq listed companies do not meet that proposed requirement. Nasdaq listed companies would have to provide diversity statistics within a year and have one diverse director within 2 years. If a company refuses or fails to add the requisite diversity hires, Nasdaq will delist the company. Nasdaq is not the first company to take on the role of moral supreme being. Earlier this year, Goldman Sachs said it would no longer ship IPOs of American companies that don't have at least one diverse board member. Apparently, Goldman Sachs only cares about diversity if it's in America. We'll still make money from people who aren't in America, but, we got a signal for American companies. But Nasdaq has serious leverage. It's a lot easier to go IPO and just not go through Goldman, but there's not a whole lot of options when it comes to stock exchanges. Nasdaq really has leverage here. They are a gatekeeper to one of the biggest stock exchanges in the world. But so long as the New York Stock Exchange does not implement a similar requirement, this means probably a good chunk more companies will be choosing to go public on the New York Stock Exchange and not the Nasdaq. Upon hearing this news, I went short $35,000 Nasdaq and long $35,000 New York Stock Exchange. I was only in this trade for 1 day and I sold at the close. I effectively broke even. I lost like $1. I guess I probably should have held on for 2 days, because if I would have held on for one more day, then, I'm like, hey, the news is out. I don't need to hold on for more than 1 day. The trade makes logical sense, but I thought it was a 1 day trade. If I would have held on to it for a little bit more, I would have made more like, $800 to $1,000, but whatever. As is my trading life lately. Okay, what else is new? Let's talk about my other trade that's not going so well. We have Salesforce. The Slackwisition, it's official, yo. On Tuesday, Salesforce confirmed it is buying Slack for $27.7 billion. Its biggest acquisition ever. Today, we're looking at what happens to your Slack shares post-acquisition. So, you got into Slack. Congratulations, you're awesome. You made a bunch of money. For each share of Slack stock that you own, you'll get $26.79 in cash and 7.8% of a Salesforce share. Slack's stock was trading at $44 yesterday. Last week, before the announcement was, announced or whatever, it was only trading at about $29. That is what we call a premium. And you got a big one if you were in Slack. Slack's work from home gains may pale in comparison to, say, like Microsoft Teams or Zoom, but they are still putting up some impressive numbers. And Salesforce should be able to add rocket fuel to those numbers. It is a clear, huge victory for Slack shareholders. Not so much for Salesforce shareholders. Salesforce shareholders really do not like this acquisition. They really don't like it, and they really don't like the amount that Salesforce paid for Slack. Salesforce is down a massive 16% since the announcement and has lost an astounding $40 billion in market cap. I'm going to say that again. Salesforce has lost $40 billion in market cap for a $27 billion acquisition in an up market. Now, I went $70,000 long Salesforce after it had lost about $20 billion in market cap. I have subsequently lost about $7,000 in this trade thus far, so good job me. I plan to start scaling out of this position in, I don't know, maybe 2 weeks, assuming nothing changes, and being completely out of the position in 3 weeks. So let's hope I end up losing less than $7,000. Maybe that would be good. Until next time, my name is Jordan Knight, and this is InvestaMania, the show where we help you get rich.